Hello and welcome to Counterpoint. I'm your guest host, Michelle Simard, and today's show is about the rise of the interest rate in Canada and what that means for the public. The interest rate has risen several times this year, most recently this month on September 7th. This change affects both borrowers and savers, and it's best to be prepared either way. To discuss the rise of the interest rate, inflation, and how to be prepared, we have Jason Mercer, Chief Market Analyst and Director from the Toronto Real Estate Board. Hello, Jason, and welcome.
Thanks for having me.
So thank you for being on the show. And to begin, have you been surprised about the rise of the interest rate?
No, I mean, when we were forecasting, even at the beginning of the year, our outlook came out at the beginning of February. We had anticipated some form of impact from rising borrowing costs. We'd actually started to see fixed rate mortgage products start to trend upwards even before the new year, and the anticipation is that would continue and even accelerate as the Bank of Canada started to move like they did in March. I think the only thing that was perhaps unanticipated was the degree to which the Bank of Canada would raise rates and how quickly they would do so. And so I think that certainly caught some people by surprise and led to a little bit more uncertainty in the market than we otherwise would have seen.
Yes, as some people call it, speculation. So that caused a definite problem within the housing market. But what does the rise of the interest rate mean for the people, essentially? Because people hear this term, the media talks about it, it's written about, but what does it really mean for the people? Can you put it in layman terms for us?
Sure. So, I mean, if you think about people who were set on purchasing a home in 2022, a lot of those individuals have moved to the sidelines. And that's not to say that they don't intend on purchasing a home as we move forward, but they have to recalibrate a little bit. And that recalibration could include things like thinking about a different home type, one that comes in at a lower price point. So for example, if you're thinking about buying a detached home, maybe now you're looking at a semi or a townhome, lower price point, it mitigates the impact, at least to a certain degree, of higher borrowing costs. On top of that, you may have some households that are looking, say, further afield, changing the geography within which they're going to purchase a home. Again, that could lead to, say, a lower price point and being able to get the type of home you want to purchase, but at that lower price point, or some combination thereof. But that decision-making process takes time. And so, if you look back the past interest rate tightening cycles, it can take about 18 months for that full impact of increasing borrowing costs to have sort of play itself out in the marketplace. But a lot of the people who are on the sidelines today will eventually move back into the marketplace. Now, another impact, of course, has been on the pricing front. So when interest rates increase, one of the relief valves, I guess you could say, is price. And so if you don't see as aggressive offers, that's because people are now looking to mitigate the impact of those higher borrowing costs. Because in reality, the great majority of home buyers in Canada are purchasing with the use of a mortgage. And so they're thinking more about monthly payments rather than the actual purchasing price. And so you'll see a lot of people start to make offers that make sense relative to what they can afford on a monthly basis. And we've seen that over the past number of months. We've seen the average selling price go from over $1.3 million in February down to around, say, 1.08 over the last couple of months.
Yes, I think what's really happening is, and even the people who are talking to their, if they're interested in buying a home, it's just not just talk. It's talking about what's my affordability, and whether they have a broker, a real estate agent, or a bank representative, they're starting to tell them logistics, saying okay, this is what we can do. Even if we extend a mortgage to 30 years, what really is going to happen here is this is what your monthly take is. And then you have to factor in all the other costs. And can you afford that? And I think that's, like you said, so it's what really people are looking at. But can you explain the process of why interest rates go up and down? 30 seconds, just to make it short and sweet for the viewers.
Yeah, I mean, in terms of the Bank of Canada's perspective, their whole focus is inflation. So we've heard a lot about inflation over the past number of months, but essentially what that's looking at is sort of that sort of basket or group of consumer goods and services that your average household was purchasing, say, on a month in, month out basis. And we've seen a real acceleration in the year-over-year price of those goods and services. We've been 6, 7, close to 8% in terms of that inflation, whereas over the long term, the Bank of Canada would like to see prices rising in around the 2% range. And so how do they throttle that? Well, they start to raise their overnight rate. That's their sort of policy rate, with the hope that higher borrowing costs will cause your average household to pull back on their spending a little bit. So there'll be less demand for those products, and you'll start to see price growth ebb.
Welcome back to Counterpoint, and here we are with Jason Mercer talking about the rise of the interest rate within Canada. There are so many things people think of when they hear an interest rate hike. Mr. Mercer, what do you think are the main issues affecting people for the interest rate hike right now?
Well, certainly my area of expertise is looking at the housing market, and so obviously, if you think about people's monthly payments with the interest rate rising, that initially saw the average monthly payment associated with a home purchase increase quite dramatically as well as we move through the spring and the summer. It obviously impacts home sellers also in terms of if you look back to say February and March. When you're seeing the average selling price, at or even a little bit above $1.3 million versus where we are today at below 1.1, that's a substantial difference as well, as home prices have dropped to mitigate higher monthly payments, and that's certainly one impact. If you look more broadly, obviously it impacts people's ability to borrow money to purchase other goods and services, and
or not to interrupt, but or even to be accepted to borrow money, because for some, I hear what your point is that to borrow money, and the question is of how much they can borrow, right? What do they qualify for? But for those who were not in that bracket yet, for those who were even contemplating of maybe I want to borrow, maybe I can buy a home, like you said, whether it's detached, semi,
Sure.
and so forth. This also affects them greatly, because now with interest rates rising, banks are going to be a little bit more conservative in their approach on who they lend to and how much they lend to. No?
Yeah, well, certainly, as interest rates increase, it limits the amount that you can borrow, because obviously you'll have to be paying more back on the interest side of that loan. And even in the housing market, for example, on top of higher borrowing costs, we also still have mortgage borrowers having to qualify under the OSFI stress test. And so they'll take their contract rate. Let's say now it's 4.5%, and you're going to say you're going to have to be qualified at the higher of 2 percentage points over and above that 4.5, or the posted rate. And so not only are you paying on an actual basis because your contract rate is increased, you're also having to qualify at 2 percentage points higher.
Yes, I know. And for those who were hoping to wait, thinking it might be for their benefit, are now looking and saying like, oh, this might be to my detriment, actually, because now I may not qualify or I may not get something that I wanted. Do you think there was any form of lack of media follow-up? Because, media always reports about it, but I mean, there's never really a follow-up of like what it really does and impacts people and where it is right today. Throughout the summer, there was a huge talk about how the real estate market was going down, and possibly it was a correction, as many people had said, because, with the pandemic, there was a huge influx, right? But there's no media follow-up. What are your thoughts about that? Because I think a lot of people get their information from the media.
Well, I think one area that we've mentioned in our last couple monthly releases is around federal policymakers. So
Yes.
If you think about CMHC and qualifications for mortgage insurance, and obviously that flows through to the Ministry of Finance as well. And if you think about the OSFI stress test, we haven't heard a lot from either the federal government or these agencies in terms of whether or not there'll be some flexibility as we move forward to account for higher borrowing costs. So OSFI, for example, we just talked about the 2 percentage point stress test. So as we continue to move through the interest rate cycle, does it make as much sense to stress test people at 200 basis points above their contract rate? It would be interesting to hear if moving forward there could be a little bit more flexibility about how that stress test is applied, especially as we move through the cycle. I mean, maybe it makes total sense to have a 2 percentage point test when borrowing costs are at or below 1%, versus, when they're at the levels that we're experiencing right now, or even a little bit higher, with the notion being, how much higher do we expect interest rates to go? Does it make sense that we're still stress testing people at 2 percentage points higher? On the mortgage insurance front, do we want to start looking at, raising the ceiling for eligibility? I mean, right now in the GTA and other expensive markets like Vancouver, you don't qualify for mortgage insurance if the purchase price of your home is over $1 million. So that really precludes a lot of individuals from A, taking advantage of mortgage insurance, and B, being able to take advantage of the lower rates that are often associated with that.
Yes, and frankly, what it really boils down to is that I think that, people hear all these things, they're going to watch the show, they're going to hear all this, but really what it boils down to is that I think people are just not quite understanding, and they rely on other people to explain it to them. But again, it's not always clear. So we're going to take a break, and I'm hoping that maybe you can put it into very simple words for people to understand truly what an interest rate is. So we'll be right back. So, prior to the previous break, we were talking about, interest rates, why they happen, and what does that mean? But can you explain in just a little bit of simplistic layman terms for our viewers, what really is an interest rate hike, and what does it really do to affect people, especially people who don't actually are planning to buy a new home or sell their home? How does that affect them?
Sure. So, I mean, we've heard a lot in the news, or really since say March of this year, about the Bank of Canada and their decision to raise, what's known as the target for the overnight rate. It's essentially their policy rate. And so when the Bank of Canada feels that prices of goods and services are rising too quickly, in this case, their target for price growth is around 2%. And we're well above that right now, 3 to 4 times that amount. They'll start to increase borrowing costs. And the idea there is that as the cost of borrowing money gets higher, fewer people will seek to borrow money, and fewer people will spend with those borrowed funds. And so as a result, you'll see the price of goods and services, gas, food, housing, what have you, you'll see that start to recede. And
the reason being is because their demand isn't keeping up with supply, then because there's, I guess, extra supply, then that means the price increases, correct?
Yeah. So if you see demand dip in relation to supply, like we've seen, for example, in the housing market over the last few months, it means that the buyer has more negotiating power. And generally what that means is it'll push prices down.
Yes, exactly. I mean, although I would argue that when you look at, maybe that's just for residential homes, but when you start looking at other properties like rental properties or, Muskoka and, commercial type buildings, that's a different ballgame, because at that point, that is not a residential home, that's not a first buyer, and that's certainly not somebody who's changing from residential, that's an extra property. So for them, before we came onto the show, I decided to, just do a broad review of everything. And I'm seeing that the trend is still quite high. I'm not seeing a huge dip like I've seen within the residential market. What are your thoughts on that?
Well, I think the rental market, you mentioned is very interesting, because if you think about, first-time buyer activity, if you think back like 5 or 6 years ago, intending first-time buyers were accounting for more than half of home buyers in the marketplace, and we've seen that share really recede to 40% or even a little bit below. At the same time, however, we've seen the population of centers like the GTA growing very strongly, especially on the back of immigration. And so while a lot of would-be first-time buyers have taken a bit of a step back, people still need a place to live. And so that's why we've seen a real tightening in the rental market over the last year or so. And what I mean by tightening is the vacancy rate has been trending lower. You're starting to see more and more competition between renters for available units, and that's really pushed average rents up. We report specifically on investor-held condominium apartment rents, and they've been up by double digits over the past couple of quarters on a year-over-year basis.
Well, yeah, and that just makes it harder for, a couple or a person who does want to buy a home. I mean, if the rent is just too high, and most of your salary is put into covering your rent and utilities and, of course, food and, all your extra stuff, how do you save to buy a home? And again, with the home market the way it is, you need 20% down. I mean, that's a lot of money. And given that, the high rate of homes, within Canada, and it just seems that the trend is like nobody wants to go, not nobody, but a lot of people want to be in city centers, major cosmopolitan centers. And again, the price is, even if you're getting a townhouse, an attached townhouse, a semi-detached, never mind a single detached, it is so difficult. A couple might have to save for 10 years before they can even think about saving the amount of money. And even when they finally save enough amount of money, will they even be able to afford that house anymore? Because now the prices have increased again. So this really is like a catch-22 here, where it's like, how do you get ahead? So essentially, interest rates are very important for people, and they're important, and why people should pay attention to them is because whether you don't feel it affects you now, it can affect you later. And it also can affect your friends and family, and whatever choices you may make later as well. Would that be an accurate statement?
Yeah, certainly. I mean, again, when you think about the housing market, people pay for their home over the long term, and that makes sense. I mean, you're using that home for a period of decades, and so it makes sense then that you wouldn't pay for it all up front. You're going to pay for it over time, just as you're using it.
Correct.
Over time, and so you're talking about 80% plus of home buyers are using some sort of mortgage with a down payment associated with it. So
and even if they don't, they're gonna likely have to borrow from friends and family because the bank won't give it to them. And with that being said, we'll be right back. Welcome back. We're here at Counterpoint with Jason Mercer talking about Canada's interest rate hike and what does that mean for our viewers and the people of Canada. So, we covered a lot of information today, Jason. Inflation, interest rate hikes, what does that mean for first-time home buyers and people who also want to buy other properties, but, also the general thing that people need to consider preparing themselves when they hear about an interest rate hike. So I want to talk about, what do you think are the key takeaways that our viewers really need to know leaving the show today?
Well, we talked a lot about what the impact of interest rates has been. I think it's also important to do a bit of a look forward when we're thinking about the housing market as well, because as I said earlier, an interest rate sort of tightening cycle, it can last for 18 months to 2 years, and so it takes that kind of period for it to have its sort of full impact and to shake itself out in the marketplace. But looking longer term, if you look at centers like the GTA, we're continuing to create jobs at a rapid pace. I mean, we're experiencing an unemployment rate that's at the lowest level since the early 1970s. We're seeing record levels of immigration into Ontario and drilling down into the GTA, which would be the single greatest metropolitan beneficiary of immigration countrywide. And so all these people are going to need a place to live. And as we talked about, right now we've seen a bit of a shift into the rental market, and that market's very, very tight. We're seeing double-digit growth in borrowing costs, but eventually you're going to see people come to terms with higher borrowing costs, or we'll see borrowing costs recede. So we'll see that movement back into ownership. And what we need to be really careful of is that we're seeing the supply of new homes coming online keeping up with this strong population growth. And we haven't seen that over the past decade. And so that's why prior to these interest rate hikes, why we're seeing such tight market conditions, because, as the population continued to grow, there was a lot of competition, for a real finite amount of supply coming online year in and year out. And so, we're moving towards municipal elections in Ontario. That's where the rubber hits the road in terms of development approvals and staging and what have you. And so it'll be important to understand where, individuals vying for public office, where they stand in terms of bringing on more housing supply. And that's not just in the Toronto area, but it's really throughout the greater Golden Horseshoe region in Southern Ontario.
Yeah, and as we know with most things with politics, there's a ripple effect that goes throughout Canada. So that being said, how can people learn more about interest rates, inflation, and staying informed so they can better comprehend what happens the next time we hear if there's a possible interest rate hike or a decrease?
Sure. I mean, at the Toronto Regional Real Estate Board, we talk about all those issues, and especially through the lens of housing, both ownership and rental. And so, if people want to visit treb.ca, that's TRREB.ca. We have monthly and quarterly reports on different aspects of the housing market. We have a podcast called Ready to Real Estate, so you can find a lot more information on the site. And certainly take advantage of those resources, especially if you're, thinking about either buying or selling a home in the Greater Toronto area.
And the real estate, looking at the trends of real estate, isn't just because you're looking to buy real estate or sell it. It's also a good marker to know what's going on with the rest of, the province, the country, in regards to interest rates. Would you agree that this could be a good marker for people to decide based on that? Because everybody needs something to learn on trends. Would the real estate market be the best trend to look at?
For sure. I mean, the real estate market is a good economic indicator overall. And one of the reasons behind that is that there's a real strong economic spin-off from each real estate transaction. I mean, we found through economic impact analysis that, close to $70,000 of additional spending in the economy accrues as a result of each sale reported through TREB's MLS system. And so that's billions of dollars a year of spin-off expenditure, related to professional services like legal fees and what have you, for renovations, for moving costs, for furniture purchases.
So it's a multiplying effect, as you said. And so it is a good barometer to test when an interest rate hikes, and it's a good marker for people to know where they should proceed and where they should not proceed. So that being said, I encourage all our viewers to look at TREB and find out what's happening next. And I really thank you for coming on the show, Jason Mercer. This is quite informative, and I'm truly grateful for having you here. So thank you.
Thank you very much.
You're welcome. Have a great day. What is clear from today's show is that interest rates in Canada may not be on the decline, and that you, our viewers, need to be prepared of what lies ahead. While the future is not grim, there is still some bumpiness along the way till we get back to the low interest rate days. I trust our guest, Jason Mercer, highlighted the important ways in which you can protect yourself, but he hopefully provided you some key insights that can help you make informed decisions moving forward. Thank you, and have a great day.